Report, where I share my 45 years of experience to help you manage your portfolios and protect your wealth. Remember to subscribe, like, and share these videos. On today's video, we'll talk about the employment numbers that are coming out tomorrow and some of the things that I think we're going to start to see. And we'll get into talking a little bit about all the fun that was going on around the White House today. Let's get into tonight's video. Well, folks, welcome. It is Thursday, so this is the final video for the week. There's a fair amount to talk about. Interesting day, I would say. All the rhetoric going on between Elon Musk and President Trump. At least Elon found out he does not run the United States of America today. That's good news for all of us. I kind of think this thing was a bit scripted, is my theory, for what it's worth. I think this was kind of the plan, all this stuff. I just saw a story, I have no idea, it was on a liberal outlet. So they were saying that Elon is saying he's going to block NASA out of space and all this stuff. So interesting turn of events, to say the least. But when you get two powerful men in the same room, anything's likely to happen, and does. I don't really have any opinions or know really what's going on there, but one of the other things that happened today was President Trump did talk to Xi Jinping, and evidently it was more constructive than combative, which was interesting. I saw a couple comments that Trump made about the rare earth and minerals and things of that sort, and we have actually a fair amount of those here, so we could, if we just let the mining happen. I live in a mining state. We get lots of big rocks, as we say here in Arizona. We have some big mountains, but we get a lot of rocks and a lot of minerals. And so as far as this impact on the positive meeting and the split up of, we'll say, President Trump and Musk, is the effects on the market was nothing. I mean, we got a little sell-off on the Musk, I think, on a couple of tweets that were going back and forth between the two of them. But in the end, I'm looking at my screen, 59.54. Same place we've been for nearly 3 weeks now, just in the same range. And like I said, it's interesting. I've checked the database, it's updated, and we're getting more traction on the short-term database. So the underlying tone, money's flowing into the market on a broader basis than a lot of folks would like you to think, at least on a short-term level. So we're picking up a fair amount of new purchases. I'll go through all that here in just a couple minutes. But as far as things go, if you didn't get the Substack yesterday, take a read of that. I always like poking at certain things that frustrate me when I see, these rear view mirror, Ray Dalio, rear view mirror traders. I don't know how he ever ran the fund. Like I said, I used to respect him a lot. He just, he now thinks that 15th century debt ratios and things matters in the world where we're about to have humanoid robotics and all kinds of animation, probably general intelligence in the next 3 to 5 years. None of that's different than it was in the great economies of the past, right? So but take a read of that if you didn't get it. Kendallreport.substack.com. That was a freebie, so you can sign up for just for a free trial, and actually just sign up as a free subscriber, and you'll see a fair amount of content that you can get. As far as we're coming into employment numbers, let's talk about that a little bit. This will be a focus. I'm going to bring up a chart here in a minute that I put in the Substack last night, and I think it is. I think it's significant, and I've been arguing for a while. Let's see, if I go back a couple years ago, I argued that the yield curve would go flat around 4.25. It's done that. I now think we'll see some front end adjustments, but I don't think they're coming now. We've got a meeting here, on the 18th and 19th of the Fed. I don't think they do anything now. Possibly September, October, end of the year window dressing to try to get them where they are. I don't think any of these softening and employment, they're out of the business. So if you think they're still in the business of micromanaging the every little bit of the employment situation, they're not. We did see a bit of an increase on the JOLTS numbers. The continuing claims numbers were actually down a little bit today. The front end of the number, which is the weekly claims, that they were up a bit. I do think those are going to change, and since I'm talking about that right now, I will bring up this chart, and I want to discuss this because I talked about it in the Substack last night, and I think it's worth going through here. And this is the continuing jobless claims, and I'm running our algos on here. These are the projection of the moving averages. Now, one of the things that happens a lot, this big spike, of course, was the pandemic, right? So you get this spike, and I talk about this all the time. And if you folks look at just charts in general, so you don't even worry about whether or not what the chart is. But whenever you get a big volatility spike like this and you get this collapse all the way down, you get what I call the echo move. And this is what's being projected. And you look at it on the big scheme of things, it's not very big. But what this really is showing us, let me blow this up a little bit so we can get a little perspective just on these numbers here. So you see the red dot is coming up. If we just look coming into the end of the year, it's projecting right here at around 2.75 million continuing claims. That's up a lot. There was some analysis that I did in the Substack, and I should have brought those up. So let me bring these up on the other screen here, and I will give you the numbers here real quick. Matter of fact, I'll drag them over if I can, just so you can see it. Yeah, let me bring this over. It's way over on my big monitor. But this was the Substack last night, and this is the numbers that I was pointing to here. One of the things that if we look at this continuing claims, I tried to get an estimate of what the unemployment numbers would have to go to equal 2.5, 2.75 continuing claims, right? So that came up to approximately 4.5 to 5% range of unemployment. That's where unemployment numbers would have to go to. And that's kind of historically this correlation that's here. So this would also take us back to 2022 levels if this were to happen. So that's why I put this chart up. And this is kind of the band of expectation that I have here on the screen. And so this is, let me zoom in a little bit. This is where we would get 2.5 to 3 million claims in this range, maybe 26 carrying into Q1 of that level. So that would be something I would consider, put that in your consideration as you're looking at forecasts going forward. And what that means I didn't go to the next level, what does that mean for the markets? I think the markets could actually, from the standpoint of equity markets, could stay fairly stable year end. Maybe we retest the lows, but we just can't seem to get above the 6,000 level. So if we go back last week, we printed, and I'll go through more details here in a minute on the S&P, but this coincides with everything. We seem to be stalling here right at this 6,000 level. We printed 608 60.08 last week, and then we did 99 a couple of days ago. We did 99.50, 50 cents, and it just rejected out of there. So there's definitely some things going on, and I think from my viewpoint, my expectations are that the markets are just going to continue in this really sloppy range. I think we could, because we're so close, we could do a print up to an all-time new high, and it's not going to go off. Somebody was saying, I don't know if it was on the YouTube channel or somewhere on Twitter or something, but someone said, but just take one Trump tweet to get the market to blow up. Well, if indeed these Chinese talks were good, all this crud with Elon really doesn't mean much, I don't think. I think maybe Elon did think he was running the country, but he found out he was not, and he will not be. So that was kind of interesting. Maybe that was the messaging that came out of this. I'm not sure. It's a lot of, everybody's got a theory on it right now. But this chart here I've been running, this is something I've been wanting to do for a very, very long time. People have been around me over the last 20 years. I've always been wanting to run metrics like this and do projections on what, from a technical, quantitative level, what these numbers would do. And this is a significant number, maybe back to the 200. This is a 200-month moving average. So that is, let me just get a number on that. That is roughly 3.1 million continuing claims. So that would put us into a 5+% unemployment level. That would definitely come out of most likely a recession of some sort. I still think we have a very strong possibility that's where we're heading, into just this mild, minor negative numbers coming out starting in Q3 and Q2. So talking about it right now and looking at the market metrics, which I'll show you here in a minute, from the database viewpoint, where I'm a little up on the tip of my skis here. I'm a little ahead of my skis. So I have to back up a little bit because most of these numbers aren't going to kick in till sometime in Q3 and 4. So we're looking a little bit down the trail. The markets probably aren't going to react to this at the moment, but tomorrow's employment number is likely to be possibly a prelude to what we're going to see going forward. Now, we saw the ADP numbers come in at 37. They're expecting 125,000 in the employment numbers. So if that comes in 85 or less, it's going to be viewed, pretty negatively. And of course, then the rhetoric will start. The Fed's going to lower rates just because employment downticked a little bit. And I don't think these metrics are. It's not a negative number, right? So I don't think these numbers are going to be that impactful here. And like I said, I do expect the Fed to lower yields and the front end of the curve in September, October, as we come into the end of Q3. And then there might be further numbers, but I still think it's part of the plan that was put in place 2 years ago, and where they were targeting the yield curve. Most people think they have been that the Fed targets the employment numbers. Well, that's what Powell says. Their dual mandate. That is not what's going on here. After massive years of this dislocation of how monetary policy was being run, artificially holding yields down, they really want them to normalize, and a normal yield curve would be probably based on economic activity right now, 3 to 3.5 on the front end, and somewhere 4.5 on the back end. That's the perfect. That's the Goldilocks. That's just perfect. And whether we'll get there or not, we'll see. But I think that's where the Fed is targeting. Still, are targeting the yield curve configuration. That's a much smarter move than trying to play into noise in the economy and jobs and that. There's nothing material going on. Now, what I'm talking about here, and I was just showing you this chart, that is a bit more material than a lot of folks are expecting. But this, we'll see how these forecasts come out. Well, good news is we'll learn over the next 4 or 6 months, and we'll get a feeling on how much we can trust some of these forecasts and how they're coming out. Now we've had some pretty good luck with these numbers going, looking back a little ways, and so I have a fair amount of confidence that at least we'll see continuing claims. My number is right at 2 million, and they actually, I think they downtick just slightly. Let me just check a number here real quick. Yeah, I think they downtick just a little bit. I'm just trying to find this number here. Bear with me 1 second. Yeah, they just downticked just a touch there. So, all right. So let's set up the rest of tonight's show, and we'll go through the typical, range of S&P. If we look back on what I've done this week, is we've really been kind of focused intermediate and longer term aspects as we come into this final month of Q2. And this is going to be, I don't think it's a pivotal month. What I'm seeing in the database, though, this is going to carry through since this is the final. We'll talk a little bit about the intermediate database and expectations there. So overall, we're looking at some pretty interesting situations. So let's go ahead and dig into the S&P. We'll go into the database here. Bring that up. So we are at 73.42%. We actually had 960 plus new entries, only 180 exits. So we got big bullish rotation again, and really a nothing market today. I mean, just a grinder, but there was obviously a lot of stocks starting to come back in to trend mode here, which is always interesting. When I run the data sheets here in just a little bit, let me just see if I can pull something off here. Yeah, let me bring. I'm going to bring this over on screen for you. Just right here. This is one of the data sheets that I run. 1 second here. Yeah, so this is, I put this out every night. I mean, this is, there's a number of elements that I put in my Substack every night that are worth it. But if I go to market overview here, what I built into this sheet here is I put in what all the different breakpoints are, and we're right now we're at this momentum alert, strong bullish accumulation detected is coming in on the intermediate database. But you can see here from a sector mode, everything is starting to come into play here, especially when we get over here to the weekly and the bigger model. So I'm showing you this because in the Substack, I put a link. If you click on that link, it'll bring you to this page, and you can go through and look at all the different performance. Now, I'm building some more intelligence into this, where it's going to tell you what the viewpoint of what this data means. So if you're just looking at numbers, they don't mean anything to you. So this will be built in, and soon, if you're a WaveTech user, you're going to have these files so you can run a bunch of stuff yourself. And ultimately, we're rebuilding the product to add all this intelligence in. But this is some of the things that I use, and I've been programming into to kind of get the forecast coming in. So, but as far as let's go over to the weekly database for a minute. We're at 40. Let me blow this up. We're at 43.92%, rate basically at 44%. I expect this because we're getting such good performance uh, out of the daily models and short-term models that we're going to see further increases here. Next numbers to watch for here is going to be 48 to 52. We get up to that level, then there's a bit more of a bullish sustainable case building here, which is, sometimes even I fight the data. I'm looking at it right now. I recognize that we're in this stable mode. That's why I've been staying with the consolidation phase right now. I have some other metrics and things that I have built in the background that I'm working with this database to come up with some further probabilities and just extrapolating out probabilities and expectations going forward. Anybody that's been around the markets for a while knows that the markets are about probabilities. So you're always playing some sort of probability on a bet. Even if you go to horse races, they got their odds, right? Those are probabilities. And so all of this stuff is really starting to tell us a little bit of more of a positive story. But if you go back to when I did the long-term approach on Tuesday, when we talked about that Monday and Tuesday on the equities, really what we're looking at, a very broad band, volatility band that is likely to stay in put all the way possibly into early 2026. So it's just going to be choppy. I don't think there's any runaway markets coming or anything up or down as far as that goes. I just think the range that we're going to stay in is going to be quite broad. So that's what everything is telling us from there. So okay, going to put you on hold just 1 second. Okay, I'm back, folks. Sorry about that. All right, so let's take a look at. Let's go ahead and go to the S&P. Yes, I see someone saying none of the stocks trade on fundamentals. Yes, they do. Okay, let's take a look here. So here's the range I've been talking about. Now all of a sudden, okay, this is an interesting comment. I got to say something. Tesla is a leading indicator for what will happen to the U.S. economy. No. Tesla is pretty much, until they get robots out. As an auto company, I think they represent like 8% of the title of autos right now, I think, in the U.S. So anyway, interesting thoughts. Appreciate them. So let's, looking at this is what we've been watching for a while, and it's been a fair amount frustrating. From the standpoint of the configuration, and as we look at what the algos are seeing, they're seeing what we're feeling, just completely flatlined. Nothing is there's. It seems like, as I've said before, we're most likely coming into one of these very frustrating periods, and I would say I've been around a lot longer trading. A lot of people have followed the markets since 1979. I've been in front of, even on a trading floor or in front of a live screen. You probably couldn't add up 2 months at times that I haven't been in front of these screens. And I can tell you, I've seen these markets before, and it doesn't feel like this is the kind of market that we could get into, but we're certainly looking like the old dog days where we have a summer of just the markets just kind of grinding, because it looks like everything that we possibly can expect at this point is somewhere down the road. There's nothing today, right? And so, when people talk about fundamentals don't matter, if there's no income, there's no debt, there's no anything, those are fundamentals, then there is no stock. So yes, it always matters. Sometimes the technicals and the quantitative can definitely drive, and market sentiment can drive. All those things are part of it, but fundamentals are also part of it. Ultimately, that's why I always suggest that you do that I refer to as reverse fundamentals, meaning you see what is possible in the charts, and then you ask if there's anything that can happen that would drive that. And right now, this uncertainty, I think it's interesting. I saw a little clip of Trump today, and he's talking about he goes, well, we already have a deal with China. I'm like, wait, what? I guess in his mind, we have a deal. This is the same thing I've said about the UK deal. There's parts of things that have been agreed upon. And I think what maybe a funny story was, I went to a Tony Robbins firewalk in 1992, did the firewalk, walked down, 18, 20 feet of red hot coals. But the point is that there was a question asked in this big, there was 2,200 of us at it, and they wanted to know, they got everybody split up in groups of 8, and they had two things that you could ask questions about to describe even education or sex. Most people in the room pick sex, and the entire room of 2,200, whatever, divide by 8 roughly, all those rooms, there were only 2 groups in that whole room that had 2 common words to relate to any of those subjects. So when you start to, I learned something that day, is when you start asking people, what a deal is, maybe there's a lot of definitions of deals. So Trump certainly has his own. I have my own, and I don't see that anything they've done so far is a deal. But it's an interesting story, because I thought about that today, maybe there's more than one definition to the word deal. So if we all got together in a room and we said, okay, we need what one word do you have that represents a deal, and we went around, we probably wouldn't find very many common words. So that's why you always need to ask people to explain themselves further when they make statements like that. So anyway, I think that the whole deal concept keeps getting more and more convoluted as we go down the trail, to the point that I don't even know what a deal is anymore. If I'm listening to between Trump and his team, I'm not even sure what that is anymore. But they all seem to be happy and they smile, so that's okay. But the markets are feeling the same thing, and this is my reason for telling this story, is that you really have to look at what these things are telling us, and it's flatline. There's not even a pulse on this market right now. And like I put out a Substack newsletter, Buy the Dip is still working. There's a couple little things. I think tomorrow unemployment numbers, if they come in under 80, 85, that's going to be not a good sign, and that may start to set some different dialogue. Maybe it'll begin to start to change sentiment just a little bit. We'll see what happens there. But for the technical, there's nothing here. I beat this thing to death this week, going from looking at quarterly to monthly to the intermediate. So, if you're bored, go back and watch. There's one of them didn't get a replay. I still haven't had a chance to to edit that thing up. I was trying to download it, wouldn't let me download it the other day, so somewhat frustrating. But the point is that this is what we're looking at. Let's go ahead and go to NASDAQ here. Same pattern, different symbol, but it looks like to me we still have a relatively slightly stronger NASDAQ than the S&P, which is typical, but we still look like we're going to roll back to the 200 at some stage, and it may be down the trail, it may be into July or so, but it looks like that's going to be a thing. You can see the 10 and 21 period moving averages daily chart is right, they're same values virtually. Let's just take a look and see what they are. 21,478, 21,276. So they're right in that little band right there. We break below that, then we're going to head toward the convergence of this 240 40-day moving averages, which is right at 20,640. So that's probably where we're going. Could there be something out of this pattern and blow us up and get a new high? Absolutely. From an index standpoint, we're not seeing very much, as I always refer to as VIG. There's no good volatility or anything in here to really push the markets either way. But our database is, like I said, we're getting more and more traction. We'll see what comes in on the intermediate. Is that underlying foundation in the market? The more symbols that you get in trend mode, the more likely the buy the dip will stay around, and the potential for another run comes into play. So we'll see what sets up here. You know, I'm sticking with my story. I've pretty much for the last 3 months still expecting Q3 and 4 to slow down. We'll see if we start to get any signs for that. If certain things come in, database kicks in on the intermediate, I'm going to have to change the story and start to go with the forward-looking part of our database. And until then, I'm sticking to the story here. Let's see, what else can we can do tonight? We're about 32 minutes in. Yeah, I'd have to agree with you, Ukraino TV. Robo-taxi might be doable. Yeah, so, this is a good comment. I do want to comment on something here. I got to zoom in here just so I can see it. Somebody said we never had a double bear market in 1 year. So if a bear... Okay, I got to address that. So the fact that a market goes up and down 20% is not a bear market. Okay, bear markets have much different tendencies. They don't go 3 months down 20, up 20. So we went bear, bull. Doesn't work that way. That's rhetoric that the media, the financial media, wants you to think about. They put these labels on percentages. They're not actual bear or bull markets. So that would be actually a really good video to do, because the fact that something moves up and down 20%, you know, like the NASDAQ is not, if anything, is in a corrective phase. All these markets are in corrective phases. So go back and watch my Tuesday video. And the reason why I kind of laugh at that stuff, because that's another one of my pet peeves. We're entering bear market territory now, and we're down 20%. So you have to look at the relative volatility. And if you look at, we had 1 day 11.3% range in 1 day. So what was that? Was that a bear market and a bull market? Same, or corrective to? I don't even know how to say it right. No, it's just volatility. It's just percentages. A bear market would be something elongated where you can see the trend flowing down, And you have to understand one other thing here, is that because of the valuations of the markets, because we're in we'll call it 5,900 to 6,000 handle, a 1% move is a big number. So now all of a sudden the numbers get bigger, everything gets bigger, volatility goes up relative to price. And so you have to look at more of what the trending and non-trending type environments are. And we're in a non-trending environment right now. And on my screen here is a three-legged decline, which typical bear markets are probably going to be in, if you're looking at it from an Elliott wave, into a 5-wave sequence and a sustained sequence. This is ABC, ABCX, ABC. These are all corrective waves. These are the kind of markets that like to steal money from people because they start thinking about things like labeling markets bear and bull. So, but right now we're really just, I still think we're going to get a dip down, and we're going to get another move down, maybe down here. And then if we come over here, everybody will be screaming head and shoulders bottoms. All that stuff's real amateur stuff, by the way. Head and shoulders bottoms and all that stuff. That's the yeah. Anyway, I'm not going to go any deeper now. I'll leave it at that. So let's go ahead and time to get 10. Let's take a quick look, because the treasuries, as we come into the report tomorrow, this was interesting, and I brought this up yesterday, is we've got some fib targets coming in here at the 416. This is on the 10-year treasury, 390. We've got some new downward fib targets. So let's do the reverse fundamentals. If this is going to happen, is there anything out there that could happen that could cause rates to dip like this? And the answer would be a really bad employment report tomorrow. It wouldn't go here tomorrow, but it might start trending if everybody all of a sudden thinks the labor market's going to soften. I am anticipating that that's what's going to happen here. I'm expecting the labor market to start to fail, because we're not pouring bodies across by the millions across the border anymore. We've seized that up. We're taking people out. We're consolidating. The economy is trying to consolidate itself right now and figure out everything. There's some deregulation going on. I think this is probably one of the more difficult times. I'm going to put this almost in a category with the European crisis of 2011, in that there was so much stuff going on in Europe that was hard for anybody on the planet to do anything because of all the issues that were going on. I think right now it's almost impossible for the world to do anything. You don't know, is there tariffs, is there not tariffs? There's no certainty around this administration right now. Maybe it's by design. I don't know. But that's why we're seeing these flat lines everywhere. And I think that's why when I was showing you the continuing claims forecast, that over the next 6-9 months, that we're going to see that number go up 500,000 to 1 million. So I made up my little smart alecky headline for the Substack, how 1 million people are going to lose their job in the next 6 months. And I think it's very, very possible. And all of these configurations are set up just right. I'm glad to be wrong, okay? And we'll deal with it. But right now, what we're seeing, like for me, the way I evaluate everything I do is how our portfolios are being managed, how those things are happening. And, right now we're still 60% invested. So we got money working. We're not 100% cash. We're not super bearish, not super bullish. We're right in the middle where you should be. And it really comes down, as I've been talking about, if the markets are going to do what I think they're going to do going forward, then you're going to have to be a really good stock picker, and you're going to have to pick stocks outside of the Mag 7 to make money. So, but this Treasury, we got a little reversal. We went all the way down to the, let me zoom in on this a little bit. We went all the way down to almost the STX level today, and then rebounded, came right back over this 40 period moving average. But we got down to 432. So this is coming more into that range, 425, 420. I think we're going to continue to work down towards this 200 day moving average. And I want you to see something here. You can see the curvature. The 200-day moving average is sloping up and starting to turn up. That will most likely be the floor around 420, 425 right now. I don't think we get much below that. If we get down here, then they're going to rebound for your bond trader. You'd be looking to take profits if you're playing alongside. But the other thing that's happening is trying to line up. We don't have a perfect, but there is a potential V bottom coming in here, which would suggest we're going to come back up and start to slope. If we get back above the red dot area here, which is 442, 445, we'll see some further upside. But it's going to be all very controlled here. So my expectation, we come into the Fed meeting, once again, nothing's going to happen. There's no reason for the Fed to do anything. Even if we get 80,000 jobs, that's okay. They would probably want to, especially with the rift between Powell and Trump, I would suspect that we will see more of a wait and see from the Fed, and we'll hear more of the same rhetoric when we get there. We'll cover that if we get closer to that point. I'm going to flash to the weekly just for a minute here. And the weekly is basically telling that same story with slightly upslope on the moving averages. We're going to stay in this range. We do have, I tell you folks about this, so there's kind of the lesson on the volatility, that normalization. So we're very close to normalizing. It's very possible if we can, next week, that the market grid will turn up on a weekly and we'll start to slope back up towards that 445, 450 level. I don't think it's anything drastic, but we'll definitely see it start to move up, maybe 450. But this range is going to stay in play here as we go forward. All right, what time we got here? Yeah, 15 to go. All right, so let's go ahead and let's go to gold. Gold has an interesting, I've been talking about this pattern here, is we've got this volatility trying to normalize, and it's like a sawtooth pattern. The red dots are still suggesting that we're going to see 30, 35, 50 or so as we go out. This is a weekly chart that we have up here, but you can see this angle of attack is pretty steep. Let me just bring this out so you can see this forecast. So we have a couple of things. We're above fib target 1. Fib target 2 is up here at that, let me just bring an exact number up here, 3650 round numbers. And that would bring us up over here probably into September, October. So gold still looks really, really strong. And it looks like there's not much to disrupt this pattern at this time. But you can see, I mean, this has been a ballistic move, to say the least. But we still have live fib targets up here. All right, we'll go to Bitcoin. I'm telling you, folks, that we're getting really close to. We still have this upward slope 10. This is a weekly chart I've got up here. This is. Let me bring up the indicators. We still have enough strength. We should hold. So anything along that line, which is going to be just trying to get this number. Yeah, 96,270 on the weekly. That would be an absolute buy the dip. If we go over to daily here, I know if we go back a few days, back to the 29th of May, no, 28th of May, these Fibonacci targets came out on that day. Those targets are 97,871, 92,500. I'm just rounding off. We also have this green dots in here. I'm going to zoom in, super zoom on that. These green dots that you see coming across here, that is what we call a pivot zone. And I'll give you that exact number here is that's 93,790. So right at that level, if we penetrate through that, then we will go through, that will be a penetration of the 200, and that would set off a pretty big decline from that standpoint. So I would suspect that we're getting pretty vulnerable here to a rollover. We've almost hit this fib target 1, and that next number is not far away at 94. So I think the low has been 101, 189. We're 101, 939. So we're trading pretty close to the lows right now. This is a very vulnerable market. And I told you folks for a while, I'm going to go back to a weekly real quick, is that this point in time, we've got these big fib targets up here, 134 plus 130, 134, 200, 157 plus, right? But there's not a lot of leeway. We've got this 10-period moving average in here. If we don't hold this weekly, we break through this. This is going to set not necessarily a huge collapse, but it's going to throw us into possibly multiple months of more choppy sideways range. And if, I'll just address something here, if Bitcoin remains kind of a risk-on asset, then that's probably what's going to happen. We're going to get in a sideways choppy, and we're going to spend, this is, the beginning of June, we're going to spend June, July, maybe into August before we're going to be in a place to actually start to move the markets, up or down from there. So I think the dog days are on us at the moment. So let's go, let me come back up. You know what, before I do that, let's bring Tesla up. Tesla's forecast is also pretty negative. It was interesting. I was looking at this, and we got some kind of new fib target. There's a couple things here. Okay, I'm glad I brought this up. Let me just bring this up here. This wheel on my mouse really rolls. Hang on a second here. So, so when we look at this pattern here, we're seeing the red dots. We got these fib targets coming up here. This red dot right here, that's another one of those pivots. When you're below it, this ends up to be a ceiling at that level. Let me just see what that price is. Price is around, we'll call it 400, 395 is that range. Hang on, I'll get you the exact number. Yeah, it is 393. So that above that, you're bullish. Below it, this kind of ceiling, we've got a pretty big rejection this week with all this stuff that's going on. The red dots are suggesting we're coming back to the 200 week. And when you zoom out a little bit, this big run we had in Tesla was impressive. Matter of fact, if you saw the Tim Waltz screaming at 240, that and he was celebrating that Tesla was at 240. If you would have bought that day, there was $100 plus run from that moment. So always when you see, we used to always say on the trading floor, the market gods never celebrate a trade unless you're celebrating with an S, SELL. So if you're kind of cheering on one of your trades, you probably should be lightening up because it's probably done if you're doing that. So words of famous Artie Blostein. So, but yeah, never celebrate. So what we're seeing here is really this pattern probably going to come back to the 200 week, and that value right now, let me just give you a value, 252. So, and if you look going all the way back to 23, we're kind of going on, and somebody is saying it's more of a meme stock. What Tesla is, and I hope what Tesla becomes, is the AI and the robotics company, because the car, being in the car business is the worst business, period. And the only reason why anyone's in the car business is because of the service, because everybody makes money on service. It's the kind of like the razor blade, right? Sell them the razor blade and then sell them the razors. And it's the same kind of business. It's a really, really bad margin business for the most part. And so that's why, I hear people say that Teslas don't need any maintenance. Well, they do. They have, there's a lot of maintenance. But anyway, there's that. Let's do NVIDIA. Let's do a couple stocks. I can just kind of roll it through here a little bit. So NVIDIA, this is kind of probably an interesting case here, because we're just looking at gold with this zigzag formation along here. This one resolved to the downside. I think gold's probably got another leg up before we get into any kind of that this kind of pattern. But this, we've basically done this big right shoulder, probably 70, 72, 73% retracement. Now it looks like NVIDIA is going to come down. I'm going to throw some up. Let's just do Apple. I mean, Apple's become not a great stock. I mean, there's rumors of Tim Cook maybe getting cooked. And I think there's even rumors right now Trump's got some kind of deal with Apple. They have, I think all of these sweetheart deals that are out there with the government ought to be looked at really hard, make sure they make sense. So this pattern here, we're back into that 200-day. I think a lot of these stocks, let's see, let's go Meta. We've kind of, Meta is actually one of the better looking ones. We do have some slight Fibonacci targets on the upside, still momentum building on an intermediate level. So that's pretty good. Let's look at Softy. Yeah, so Microsoft's got much better look than a lot of these others, but it's very close to stalling. It looks like, though, that there'll be an upward bias on Microsoft into July, August. But it looks like it's trying to flatten out here just a bit. But we're right at these peak levels. So everything is kind of evolved into peak levels from that standpoint. So come back up and just look at a couple of your comments. Let's throw a couple. Motley Fool are they still around? I didn't know they still were around. So David Ford saying Tesla's a tech business. it's an AI and hopefully a robotics business, not a car business. Cars, the whole robo-taxi. I mean, everybody give me a like, hit the like if you've actually ridden in an actual taxi, maybe an Uber, if you're around cities. But most people are not going to use anything like that. Let me just look at a couple more things here. Yeah, when's the last time you got a cab at 2 in the morning? 24 hours a day? No one cares. No one's going to do that. It's just, people are sleeping at 2 in the morning. I know a network of people that are Uber drivers, and they don't get a lot of rides after. In college towns, up to about 2 in the morning. After that, it just falls off the cliff. Hang on, I'm just trying to get to comments here. Yeah. I'm just looking at a few more comments, and then we'll close it down for the week. Yeah, it's interesting. JV, I see BOJ is expecting increased rates on the 17th. Yeah, that's interesting. I'll look into that, Jay. Appreciate that comment. Yeah, someone wants to know empty promises by Tesla. Like, I don't know, 5 or 6 years of them. I mean, there are quite a few. Musk is very good at over-promising and under-delivering. That's for sure. I'm just looking at a couple more comments, folks. I don't get a chance to look at these when I'm talking. So, yeah. And I agree with the Tesla does not trade on fundamentals. It does and doesn't. Only at earnings days, right? Only when the earnings are coming out. Yeah. Yeah. Okay, folks. We'll call it quits here. Pretty busy week, it felt like for me, from the standpoint of what the markets are doing. There's something I didn't do, and I hate to do it at this point in time. Let me look at something here, because I did run the data sheet for the S&P, and I did not show it to you. Now I know why. Yeah, we'll do this the last thing. I apologize. This will take just a second to get this link. All right, I will bring this up on the other page. Okay, I apologize. I get into the flow sometimes, and all right, let's do this. Last thing at the end. Yeah, so we got targets R2 59.72, S1 59.24. Another range. I suspect that the range maybe will blow up depending if we get any surprises on the employment numbers. Momentum's improving. This is kind of coming into this critical test level. I agree. RTX today, 6,004. see what kind of trades. Long break 59.56 plus, the target 59.72. Rejection short 59.53 to 59.24. That one looks kind of interesting. Yeah, I'm just looking. I have screens up above me here. All right, I put a light trade on that. So, all right, folks, let me come back up. All right, so make sure that you get the Substack, folks. KendallReport.substack.com. $8 a month, 7-day trial. You can get a full year for $80 right now. So you can sign up for that. It ends up being like $6.50. You got 8 trades that come out every day. You get these dashboards, a whole bunch of stuff, and yeah, we got some pretty cool stuff that we're working on for the community. Just everything takes longer than you think it does. So anyway, listen, have a great weekend. Have a good day trading tomorrow. Good luck on everything, and we'll see you Sunday night. Take care.